We stash our cash in a savings account because of its perceived safety. You deposit your paycheck, the bank holds onto it, and your balance stays exactly where you left it. Roughly 90% of people leave their surplus income sitting in these accounts. The trade-off for that zero-risk environment is that you stop actively building wealth, while the bank loans your money out to make a profit. This split-screen chart shows the mathematical reality. On the left, you have a standard bank yield crawling upward at a fraction of a percent. On the right, inflation, the rising cost of living, climbs at a much steeper angle. That expanding gap between the two lines represents a steady, guaranteed loss of your purchasing power over time. To stop that decay, you have to acquire assets. But the moment you decide to invest, gurus hit you with conflicting pitches. Buy real estate, launch an e-commerce store, day trade volatile stocks, or create digital courses. The problem is, trying to buy an apartment building when you barely have a down payment, or launching a demanding side business when you already work 60 hours a week, practically guarantees failure. Achieving financial independence isn't about hoarding every type of investment. It requires finding the one specific asset class that aligns perfectly with the constraints of your current life. This 2x2 matrix evaluates all potential investments against the two resources you possess, time and money. Let's look at the top left quadrant. This is the zone for high-effort, low-capital investments, which we'll call sweat equity. This category includes acquiring high-income skills like coding or video editing, building digital assets like ebooks and online courses, or launching an e-commerce storefront. These don't require huge bank loans or angel investors. They require you to sit at a desk and pour hundreds of hours into learning, creating, and iterating, often with zero financial cost. Once built, a digital asset or a well-oiled e-commerce site scales. A course you recorded once can be sold 1,000 times, generating revenue whether you are actively working or fast asleep. The trade-off is severe. You will do massive amounts of uncompensated labor up front. The gratification is heavily delayed, and many of your initial attempts will simply fail to gain traction. With sweat equity, you are paying for the asset's growth with your personal life energy and focus, rather than your wallet. This matrix shows the opposite approach. Down in the bottom left quadrant are investments for people with consistent cash flow but no free time. We'll call these passive protectors. This category holds reliable, low-effort assets: mutual funds, physical or digital gold, and government bonds. For mutual funds, the primary engine is the Systematic Investment Plan, or SIP. You aren't picking individual winning companies. You are buying small slices of the entire market to spread out your risk. The inputs are completely automated. You set up a monthly deduction from your checking account to buy into these funds or acquire inflation-resistant commodities like gold, and then you leave it alone. Professional fund managers handle the complex research and rebalancing. Your money benefits from compound growth and protects its purchasing power against inflation, demanding zero daily oversight from you. The drawback here is the speed. Accumulating wealth this way is slow. It lacks the immediate thrill of picking a breakout stock or flipping a startup. It also requires immense psychological discipline. When the market dips and your portfolio shrinks, you have to resist the urge to panic and sell. Passive protectors are not tools to rapidly get rich. They are the essential defensive mechanisms ensuring you never become poor. Finally, this matrix maps out a tier for investors who possess both substantial capital and a high tolerance for risk, up in the top right quadrant. These are the aggressive accelerators. Here we find physical real estate, direct stock picking, business ownership, and venture capital. These assets demand serious inputs. You are deploying massive sums of money into down payments or equity stakes, and frequently managing complex teams or physical operations. When executed correctly, the outcome is exponential cash flow. This quadrant offers the highest possible ceiling for building permanent, generational wealth. But the trade-offs are steep. You expose yourself entirely to market volatility, interest rate fluctuations, and the statistical reality that most startups and new businesses fail. Aggressive accelerators act as a financial magnifying glass. They have the power to amplify massive dolls, but they will just as quickly amplify devastating personal losses. This flowchart maps out your immediate next step based on your primary constraint. If your main limitation is cash, follow the no money path. You are the bootstrapper, focused entirely on sweat equity. Ignore picking individual stocks or real estate financing. Direct your energy into high-income skills or digital products. Alternatively, if you work demanding hours, follow the no-time path. You are the busy professional, stepping into passive protection. Ignore the side hustle hype. Funnel surplus cash into automated SIPs, mutual funds, and bonds, letting the market work while you focus on your career. If you have substantial savings and can manage risk, follow the excess capital path. You are the capital allocator. Unlocking exponential growth at this stage means accepting the burden of operational oversight, whether that's vetting a startup or managing a real estate property. Trying to skip across these categories out of sequence, like buying a business when you have no cash reserves, or day trading when you work a full-time job, is exactly how novice investors lose their money. Building lasting wealth doesn't require knowing every financial trick. It requires making a deliberate, self-aware choice about which resource, your time or your money, you are willing